Look, I need to tell you about something that happened in August of 1976 that most people have completely forgotten about, but it perfectly explains why you're struggling to build wealth while the ultra-rich keep getting richer without apparently doing anything. The man's name was Jay, Paul Getty, and when he died, he was worth approximately $6 billion. That's in 1976 money, which is about 30 billion in today's dollars. Here's the crazy part. When the IRS went through his estate, they discovered something that made their jaws drop. Getty had paid almost zero income tax for the last 15 years of his life, despite living in massive mansions, flying private jets, and acquiring art collections worth hundreds of millions. He wasn't hiding money in Swiss banks. He wasn't doing anything illegal. He was using a strategy so simple, so elegant, that once you understand it, you'll never look at wealthy people the same way again. And here's what really makes me frustrated. This strategy is still being used today by every single billionaire you can name, and nobody's talking about it in plain English. Let me bridge into something important here, because what I'm about to show you changes everything. Right now, today, the wealthiest people in America are using a 3-step process that allows them to live like kings while reporting almost zero taxable income to the IRS. They're not breaking any laws, they're not even bending rules. They're using the tax code exactly as it was designed. And the financial industry absolutely does not want you to understand how this works, because the moment you do, you realize the entire game is rigged from the start. My name is David, and I spend way too much time thinking about how the ultra wealthy structure their finances to avoid ever paying taxes on their fortunes. If you're someone who works a regular job, pays taxes on every dollar you earn, and wonders why you can never seem to get ahead while reading about billionaires who somehow pay lower tax rates than you do, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. By the end of this video, you'll understand the exact 3-step mechanism that billionaires use to extract millions from their wealth without ever triggering a single dollar of income tax. And more importantly, why the system was specifically designed to benefit asset owners while punishing wage earners like you. As usual, I need to tell you a story, and this one's gonna make you angry. Let me take you back to the early 1980s. There was a guy named Ronald Perelman, and if you don't know the name, just know that by 1988, he was worth $5 billion. But in 1980, he was just getting started with about 10 million to his name. Here's what he did. Perelman identified a company called MacAndrews & Forbes, a licorice extract and chocolate company trading for about $40 million. He didn't have $40 million in cash, obviously. So what did he do? He bought the company using something called a leveraged buyout. He put down about $2 million of his own money and borrowed $38 million from banks. The banks were happy to lend because the company itself was the collateral. Perelman now controlled a $40 million company while only spending $2 million. Here's where it gets interesting. Once he owned MacAndrews & Forbes, he started buying other companies using the same trick. He'd target a profitable company, borrow money using MacAndrews as collateral, acquire the new company, and then use that company's assets to borrow even more. Step 1, identify target. Step 2, borrow against existing assets. Step 3, acquire new asset. Step 4, use new asset to borrow more. It was a debt spiral, but in reverse. Instead of drowning in debt, he was building an empire. Why would banks keep lending to him? Because every company he bought had real assets, buildings, inventory, patents, cash flow. The banks looked at the collateral and said, sure, here's another 100 million. Perelman was essentially pyramiding debt, but doing it legally and with the full support of major financial institutions. But here's the catch. All of this happened during a massive bull market in the 1980s. Asset prices were going up every single year. The companies Perelman bought in 1981 for 50 million were worth 80 million by 1983. The debt stayed the same, but the assets kept growing. He was getting richer on paper without selling anything, which meant he wasn't paying taxes on any of those gains. By 1985, Perelman used this exact strategy to buy Revlon for $1.8 billion. Again, mostly with borrowed money. He put down maybe 300 million and borrowed 1.5 billion. The banks were throwing money at him because the math worked. Revlon's assets were worth more than the loan. Now, you might be wondering, how is he living? How is he paying for his mansions and yachts and private jets? He's not drawing a salary because salary gets taxed at the highest rate. He's not selling stock because that triggers capital gains tax. Instead, he's doing something brilliant. He's borrowing against his assets. Let's say he owns stock in Revlon worth $500 million. He goes to a private bank and says, I need $20 million in cash for living expenses. The bank says, no problem. We'll lend you $20 million at 3% interest using your Revlon stock as collateral. Perelman now has $20 million in cash, completely tax-free, because loans aren't income. He lives off that $20 million, and the interest on the loan is tax-deductible. Meanwhile, his Revlon stock keeps growing in value. By the time the loan is due, his stock is worth $600 million. He takes out another loan to pay off the first one, still without selling anything or paying taxes. In 1989, the junk bond market collapsed. Michael Milken, the guy who had been funding most of these leveraged buyouts, got arrested. Credit dried up overnight. Companies that had been borrowing to grow suddenly couldn't refinance their debt. But here's the kicker. Perelman had already moved most of his wealth into assets that generated cash flow. Even when the market crashed, he could service his debt. Smaller players who had copied his strategy without understanding the importance of cash flow got wiped out. They were left holding companies they couldn't afford to keep and debt they couldn't pay. Banks foreclosed, fortunes evaporated. Perelman walked away, not just surviving, but thriving. He had used the crash to buy distressed assets for pennies on the dollar, using, you guessed it, more borrowed money. And here's the thing that really matters. During this entire period, from 1980 to 1995, Perelman paid almost zero income tax. He reported losses in most years because the interest on his loans was deductible. Meanwhile, he was living a lifestyle that cost tens of millions per year, all funded by tax-free loans. So what does this have to do with how billionaires avoid taxes today? Everything. Just like Perelman profited from a system that allowed him to borrow indefinitely against growing assets, today's billionaires are profiting from the exact same pattern. They buy assets, watch them appreciate, borrow against them to fund their lifestyle, and never pay income tax because they never actually sell anything. The strategy has a name now. It's called buy, borrow, die. Let me make this even more concrete with something you can relate to directly. Imagine you bought a house in 2010 for $300,000. By 2020, it's worth $600,000. You've made $300,000 in profit, but you haven't paid any taxes on it because you haven't sold the house. That gain is unrealized. Now imagine you need $50,000 for your kids' college tuition. You have two options. Option one, sell a portion of the house, somehow, and pay capital gains tax on the profit. You'd owe about 15% of the gain, so maybe $7,500 in taxes. Option two, take out a home equity line of credit for $50,000. The bank is happy to lend because your house is worth way more than you owe. You get the $50,000 in cash, completely tax-free, because it's a loan, not income. You pay maybe 4% interest, which is $2,000 per year, and that interest is tax deductible. You've just accessed your wealth without paying a dime in capital gains tax. Now scale that up. Instead of a $300,000 house, imagine you own stock worth $5 billion. Instead of needing $50,000, you need $20 million per year to maintain your lifestyle. You do the exact same thing. You borrow $20 million from a private bank using your stock as collateral. The interest rate is maybe 2% because you're a billionaire and banks give you better rates. You pay $400,000 per year in interest, which is tax deductible. Meanwhile, your $5 billion in stock grows by 7% per year on average, so it's now worth $5.35 billion. You've accessed $20 million in spending money, paid zero income tax, deducted the interest, and your net worth actually went up by $350 million. You didn't just avoid taxes, you got richer while spending. This is what every billionaire is doing. Bezos, Musk, Buffett, Zuckerberg. They own assets worth tens of billions. Those assets grow every year. They borrow against them to fund their lives. They never sell, so they never pay taxes. And here's the most insane part. When they die, their heirs get something called a stepped-up basis. Let's say you bought stock for $1 million and it's worth $1 billion when you die. Normally, if you sold it, you'd owe capital gains tax on $999 million in profit. But if you never sell and you die, your heirs inherit that stock at the current value of $1 billion. Their cost basis steps up to $1 billion. If they sell it the next day for $1 billion, they owe zero taxes because there's no gain. The $999 million in appreciation just vanishes for tax purposes. Buy the asset, borrow against it to live, die, and pass it to your heirs tax-free. Buy, borrow, die. Now let's talk about who benefits from you not understanding this. The antagonists here aren't some shadowy conspiracy. They're the major financial institutions, private banks, and wealth management firms that facilitate this entire system. Companies like Goldman Sachs, Morgan Stanley, JP Morgan, and specialized private banks like Northern Trust. These institutions have entire divisions dedicated to making securities-backed loans to ultra-high net worth individuals. Why? Because it's incredibly profitable for them and it locks wealthy clients into their ecosystem. Here's the motive. When a billionaire borrows $50 million against their stock portfolio, the bank charges interest. Let's say 2%. That's $1 million per year in revenue for the bank, essentially risk-free because the loan is backed by liquid securities worth way more than the loan amount. But it gets better for the bank. That billionaire probably also has their brokerage account, their estate planning, their trust management, their philanthropic foundation, all at the same institution. The bank is collecting fees on every single service. They're managing $2 billion in assets and charging 1% per year. That's $20 million in annual fees. They're providing tax strategy advice and charging for that. They're facilitating private equity deals and taking a cut. One client can generate tens of millions in revenue annually. Now, why would these banks want you, a regular person, to understand this strategy? Because if you understood it, you'd ask uncomfortable questions. You'd demand policy changes. You'd vote for politicians who want to tax unrealized gains or eliminate the stepped-up basis. The entire system depends on most people not understanding how it works. As long as you think billionaires are just smarter or work harder, you won't question why they pay lower tax rates than you do. Here's how they hide it. Tactic 1, complexity. They bury these strategies in trusts, LLCs, family offices, and offshore structures. The average person sees a billionaire's tax return, if they ever see it at all, and it's hundreds of pages of incomprehensible legal jargon. By the time you've tried to parse the first page, you give up. Tactic 2, language manipulation. They don't call it avoiding taxes. They call it tax-efficient wealth management, or strategic asset leverage. It sounds sophisticated and legal, which it is, but the effect is the same. Zero tax paid. Tactic 3, lobbying. The financial industry spends hundreds of millions per year lobbying Congress to keep these loopholes open. They frame it as encouraging investment and economic growth. They say closing these loopholes would hurt the economy. What they really mean is it would hurt their fee revenue. Let me reframe this for you emotionally, because I think this is where people get stuck. You're not a victim here. You're just playing a different game with different rules. The ultra-wealthy aren't cheating. They're using the rules as written. The system was designed this way intentionally. Once you understand that, you stop being angry at billionaires and start being angry at the system. And more importantly, you can start thinking about how to use pieces of this strategy yourself, scaled to your level. You're not going to borrow $10 million against your stock portfolio because you don't have one, but you can absolutely use the same principle. If you own a home with equity, you can borrow against it at low interest rates instead of selling investments and paying capital gains tax. If you own a small business, you can retain earnings in the business, let it grow in value, and borrow against the business instead of taking a salary. If you have a brokerage account with $100,000 in it, most brokers will let you borrow up to 50% of that at relatively low rates. You can use that to invest in opportunities without selling your existing positions and triggering taxes. The mechanism is the same. The scale is different. Now, let's get to what you actually do about this, because understanding the problem without action is useless. Action step 1. If you have any investment account worth more than $50,000, call your broker today and ask about their securities-backed line of credit. Most people have no idea this exists. Fidelity, Schwab, E-Trade, they all offer it. You can borrow up to 50% of your account value at interest rates usually between 5 and 7%. Here's why this matters. Let's say you have $100,000 in stocks and you need $10,000 for an emergency. Most people sell $10,000 worth of stock, pay capital gains tax, and lose a chunk to taxes. Instead, you borrow the $10,000. You pay maybe $600 per year in interest. Your stocks stay invested and keep growing. If your portfolio grows by 8% per year, you're actually coming out ahead even after paying the interest. You've accessed cash without selling, without taxes, and your wealth keeps compounding. Action step 2, and this is critical. If you own a home, you need to reframe how you think about home equity. Most people see home equity as retirement security. They want to pay off the mortgage and own the house free and clear. That's emotionally satisfying, but financially stupid if you understand how the wealthy think. Here's what you do instead. Keep a low fixed rate mortgage for as long as possible. If you have a mortgage at 3%, do not pay it off early. That's the cheapest money you'll ever borrow. Instead, if you need cash, open a home equity line of credit while you're still employed and your credit is good. Don't use it yet, just have it available. When you need money, instead of selling investments, you pull from the HELOC. The interest is low, often tax deductible, and your investments stay in the market compounding. You're doing the same thing billionaires do, just with smaller numbers. Action step 3. If you're self-employed or own any kind of business, even a side hustle, you need to set it up as an LLC or S-Corp immediately. Here's why. When you're a W-2 employee, you get taxed on every dollar you earn before you see it. When you own a business, you get taxed on profit, which is revenue minus expenses. That means you can deduct your home office, your car, your phone, your internet, travel, meals with clients, education, equipment. Things you were already spending money on become tax deductible. But more importantly, you can retain earnings in the business. Let's say your side business makes $50,000 in profit. Instead of taking it all as salary and paying taxes, you take $30,000 as salary and leave $20,000 in the business. You use that $20,000 to invest in assets the business owns. Maybe the business buys index funds, real estate, equipment that appreciates. Those assets grow tax-deferred inside the business. When you need money, the business can lend it to you, or you can borrow against the business assets. You're creating your own mini version of buy, borrow, die. Action step 4, and this one is for people who are serious about building wealth. You need to shift your entire mindset from earning income to acquiring assets. Income gets taxed immediately at the highest rates. Assets appreciate without being taxed until you sell them. And as we've discussed, you never have to sell if you borrow against them. Every dollar you earn from a job should be going toward buying assets. Stocks, real estate, businesses, intellectual property, anything that grows in value over time. The goal is to build a pile of assets large enough that you can borrow against them to fund your life. At that point, you're in the same system the billionaires use. Let me give you the math on this because I think it crystallizes the whole concept. Let's say you're 30 years old and you manage to save and invest $500,000 over the next 20 years by age 50. You invest it in a diversified stock portfolio that averages 7% annual returns. By the time you're 65, that $500,000 has grown to about $1.4 million. Now, traditional retirement advice says you withdraw 4% per year, which is about $56,000, and you pay taxes on that. But here's the better way. Instead of withdrawing, you borrow against the portfolio. Most brokers will lend you 50% of the value, so you can access $700,000 in borrowing capacity. You borrow $50,000 per year at 5% interest. That's $2,500 per year in interest, which is tax deductible. You pay zero income tax on the $50,000 because it's a loan. Your portfolio continues to grow at 7%, which is $98,000 per year on $1.4 million. You're paying $2,500 in interest, and your portfolio is growing by $98,000. You're spending $50,000 per year tax-free, and your net worth is still going up by $48,000 annually. When you die, your heirs inherit the portfolio with a stepped-up basis. They sell enough to pay off the outstanding loan, pay zero capital gains tax because of the step-up, and inherit the rest. You've lived off your wealth without ever paying income tax on it, and you've passed it on to the next generation efficiently. That's buy, borrow, die at the middle class level. Now, here's what makes me genuinely frustrated. This information isn't secret. It's not hidden. Every financial advisor to wealthy people knows this. Every private banker knows this. Every estate planning attorney knows this. But it's never explained to regular people in plain English because the financial industry makes more money if you don't understand it. They want you to keep working, keep earning income, keep paying the highest tax rates, and keep your money in their managed accounts where they collect fees. The system is designed to extract maximum taxes from wage earners and minimum taxes from asset owners. If you work a job and make $100,000 per year, you pay maybe $25,000 in taxes. If you own assets worth $10 million that appreciate by 10%, you made $1 million in gains and you pay zero taxes until you sell. And as we've covered, you never have to sell. The person working pays 25% of their income immediately. The person with assets pays 0% indefinitely. Here's the thing most people don't realize, and this is where it gets really interesting. The tax code isn't broken. It's working exactly as designed. It was written by and for people who own assets. The income tax was introduced in 1913, and from the very beginning, it had carve-outs for investment income. The mortgage interest deduction was created to encourage home ownership, but it benefits people who keep mortgages and invest the difference. The capital gains tax rate is lower than the income tax rate, specifically to encourage investment. The stepped-up basis rule exists to make wealth transfer easier for rich families. None of this is accidental. If you're someone who's been told to work hard, save money, pay off debt, and invest for retirement, you're following advice designed to keep you in the income tax system forever. You'll pay taxes on every dollar you earn from your job. You'll pay taxes when you withdraw from your retirement accounts. You'll pay taxes on Social Security benefits. You'll pay property taxes. Sales taxes. Every interaction with your money involves the government taking a cut. Meanwhile, the ultra-wealthy structure their entire financial lives to avoid triggering taxable events. They earn no salary, they realize no capital gains, they take no distributions, they just borrow, live, and grow their wealth. Let me be very clear about something, because I know some people are going to hear this and think it's some kind of anti-tax rant. It's not. Taxes fund important things: infrastructure, education, defense, social programs. I'm not saying taxes are bad. I'm saying the current system is fundamentally unfair because it taxes labor at high rates and wealth at low rates or not at all. A nurse making $60,000 per year pays a higher effective tax rate than a billionaire whose net worth grows by $1 billion. That's not a functioning system. That's a system designed to entrench wealth with people who already have it. And here's the part that should make you the most angry. The people benefiting from this system are the same ones telling you that you need to pay your fair share. They're funding think tanks that publish studies saying we can't afford social programs. They're lobbying against wealth taxes, estate taxes, and unrealized gains taxes. They're spending millions on PR campaigns to convince middle-class people that taxing billionaires would somehow hurt the economy. It's gaslighting on a national scale. So what do you do with this information? You stop playing the game you're told to play and start playing the game the wealthy actually play. You shift from earning income to acquiring assets. You use debt strategically instead of fearing it. You structure your finances to minimize taxable events. You take advantage of every deduction, every credit, every loophole that's available to you. And most importantly, you stop feeling guilty about it. The rules are the rules. You didn't write them, but you can absolutely use them. The financial industry doesn't want you to know this because an informed population is a dangerous population. If everyone understood buy, borrow, die, they demand the system be changed. They'd vote for politicians who promise to tax wealth, not just income. They'd stop accepting the narrative that billionaires are job creators who deserve special treatment. The whole facade would collapse. So they keep it complicated. They keep it hidden in legal jargon and financial products with confusing names. They make you feel like you need to pay someone to understand your own money. You don't. You just need to understand the basic mechanism. Assets appreciate without being taxed. You can borrow against assets without triggering taxes. When you die, your heirs get a step up in basis that erases all the gains. Buy, borrow, die. 3 words that explain how every billionaire in America avoids income tax legally. If this video made you angry, good. You should be angry. But channel that anger into action. Look at your own finances and ask yourself, am I structuring this to minimize taxes, or am I just doing what I'm told? Are my assets working for me, or am I working for a paycheck that gets taxed into oblivion? Can I borrow against what I own instead of selling and paying capital gains? The answers to those questions will determine whether you stay trapped in the income tax system or start building real generational wealth. And if you found this helpful, make sure you're subscribed, because I break down these kinds of financial mechanisms that nobody else wants to explain in plain English. Hit the like button, share this with someone who needs to hear it, and I'll see you in the next one.